This tutorial about the goods and services tax will talk about the theory behind it, and in particular how to account for transactions that have the GST component involved in them. So let me talk about a bit of theory first, and then I'm going to show you how to do the general journal entries using an illustrative example in the book. Okay, so GST is an amount of usually 10% collected by businesses whenever a purchase of a good or service occurs. 10% has to be charged on every sale that is made. Some items, like food for example, non-processed food, are GST free, so there's no GST on those items. Usually the business has to pay every month or every quarter, and they do so in a thing called a business activity statement. We don't have to know about that, but you may have heard about that, so I'm just mentioning it in passing. But that's a mechanism that businesses actually use to pay the total amount of GST to the government, either every month or every quarter. Now, another aspect about GST is that businesses, if they pay for goods and services that got GST on them and then use them in their business's production process, they then get rebates for it, because essentially items shouldn't be taxed twice. So whenever there's a purchase, then the business is able to get a rebate, and I'll show you that later how that occurs. Let's look at a simple calculation. It's done on the cost of input of any good or service that is sold. Okay, so if we have got an article of clothing, say for argument's sake it's $100, we've got to add on the 10%. That's a bit that the businesses collect on behalf of the government, and advertised sales price in Australia by legislation must always include the 10%. Okay, let's assume that we've got an item that we've purchased from our suppliers for $400. We must charge 10%, so add on the $40. So the sale price there you can see is $440. Another way of looking at it, and you will be presented with this little complication, is that you might get a transaction which includes the GST already in it, and then it's up to you to calculate that GST. Just remember, we have the component of, say, $400 plus that extra 10%. That's why for any amount you have to divide by 11 to get that one item that you need, that is the GST. And here's your calculation. So for example, the sale price is $440. You divide that by 11 and you get the GST of $40, and that's the component that we must remember in order to account for the GST, either as a rebate or indeed if we sell a good or service. Here's another way of looking at it. If it's priced before GST, we divide by 10 to add the GST component on, but like I've just shown you, if we have got the price including GST, we must divide by 11 to get the GST component, and I'll show you some practical examples in a moment to see it at work. Here's an example of a invoice. You can see here these two items here, because they're non-processed food, they haven't got any GST, but these processed items, which by legislation are GST inclusive, that must be included there, as you can see. And then down the bottom here, which I'm not showing you, is the total amount payable. In this case, it'll be these don't have GST and these two items do. Okay, so how do we account for it in the general journal? So when we buy goods and services, whether I'm in a jeans store, I buy some jeans and I pay GST on that, but I want to sell them at a profit, then that amount I must be able to get rebated, or alternatively, if I have other costs like rent and so forth, I then have to account for this thing called GST credits received, which appears as a debit item, which I'll show you in a practical example in a little moment. On the other side, when we sell goods and services, we have to collect these monies on behalf of the government, and we have this item which ends up being a liability. That's why it's being credited there every time we make a sale. Now that's the theory behind the GST. If you're a bit unsure, exercise 3.6 on page 69 is a good little exercise to do. Over the page on page 70, it shows you the tax invoice and how it all works in terms of all the calculations. So that's a bit of reinforcement for you. But where I'm going to go to now is to do the illustrative example, which is on page 76, and I'm going to show you how those entries work using Excel. So here I've got a spreadsheet which highlights the entries that are listed in the illustrative example on the bottom of page 276. You can see on May the 2nd, commenced business, May the 4th, and so on. And what I'm going to do is to show you how to enter these into the general journal for each entry. Okay, let's begin. So we commenced business. I haven't got all the bits and pieces up there, but the date is May the 2nd. The first thing was that we had cash at bank. Type that in. We increased the cash at bank, so therefore it's $15,000. Another item that was introduced was a motor vehicle. If I'd spelled that right, that'd be good too. There's $20,000. The third item, we introduce some equipment to the business. So you may be wondering how all these things are being put into the business, but I dare say this person was operating as a hobby business before and now decided to turn it into a full business. And now we get to an item P. Patrick. Now you've got to be careful here, because this is an item that is owed to P. Patrick and has been introduced as a debt. So it was before it was a personal debt. Now we've transferred it into the business. I might just do my spelling right there. And the last entry here, we can use the accounting equation. We take all those assets there and take away that one liability, and what we get is $38,500. Alright, let's just check that that side equals that side. So that equals to 39, that equals to 39. So what we've done is a balanced entry here, and I forgot to put in the amount that goes to the capital account. So that's the first entry that we've done. You notice that that's just a bit of revision. No GST has occurred yet, but that'll occur with the next entry. On May the 4th, we purchased consumable supplies for $550, GST inclusive. So we've got to work out what the GST component is. Remember, you've got to divide it by 11. The figures is quite easy, so we know the GST component is $50. Okay, we're going to remember that. But the whole general journal entries is going to be as follows. On May the 4th, okay, we bought some consumable supplies. So that's our debit item, it's an expense. Now, that was only for $500, because the other item, which is the new item that we have to account for, is a GST credits received. And that's the $50 amount of GST that we purchased with that item. And lastly, we purchased this from Paint Supplies. So this is a credit transaction. Typing that in. For $550. So that is the credit. So let's just revisit this. So we bought some consumable supplies for $500. The GST on that amount is $50. You can see that that plus that equals to $550, and that's the amount that we're going to owe to our supplier, Paint Supplies, $550. So it's a little bit different, where we're going to have to calculate the GST component there, $50, and reduce that to the original cost price. Okay, it's a little bit different. I'll keep moving and reinforce that particular concept. So on May the 11th, we had our third transaction, we paid some advertising. So let's just deal with the advertising first. All right, that's for $660. All right. How about I put the amount of GST first? We calculated that amount. All right. If we take the $660 divided by 11, we get 60. Okay, and the remainder of that $660 is obviously $600. All right. So once we've done that, you can see that's another way of looking at and deriving those two entries there. Now we paid cash for this, so it's cash at bank. That's $660. There we go. So again, checking, we've got at least one debit and one credit. We've got the amount of debits equal the amount of credits, so it's all okay. Okay. Moving on to May the 23rd, we've actually got we've done some work. We charged some fees to J Johnson. Now J Johnson owes us $825. So J Johnson is a debtor, and he's going to owe us, or she in this instance perhaps, $825. Now what is it for? Well, it is for services performed, but again this $825 has got a GST component in it, so we need to divide that figure by 11 and we're going to get 75. So I might just put that amount in there first, like I did in the previous transaction. In this instance, because it is a sale, we've got a different account called GST collected. So that's how much we've collected and we're going to pass on to the government, and the remaining item is the service performed, the revenue account that we've got here. Okay, so if we look at that, we've got J Johnson asset owes us $825 on the debit side, comprises of two credits. One is the GST collected and the services performed. So that's the revenue account, and this is the other liability account. All right, hopefully you're getting an idea there. I'm going to do the last entry here. In this instance, we have again provided some services, but this time for cash. All right, so be careful not to be put off the fact that it's for Ngani, but it does say for cash, so we've got a cash at bank item coming up. So on May the 30th, we've got cash at bank straight away, and that was for $440. Again, we must divide that amount by 11, so that's the GST collected. Right. So I'm going to put in $40 there, and it's again service was performed. You can see what I'm doing here. I'm just being a little bit lazy, but or efficient if you like, by linking them up to something like that, so I don't have to type it again. Let's check this transaction. We made some services, we performed some services, we've got $440 of it. Unfortunately, we've got to give 10% or to the government, and we keep 400, which goes in our revenue statement later on. So there is the full set of General Journal transactions that you'll see now on page 77. Hopefully that's been useful to you. And what I'm going to do in a minute is to give further illustrative examples, but this time looking at for the transactions for a trading enterprise, which is illustrated on page 84. Let's go to that. Being a trading business, it has a couple of complicating factors. One, when we deal with credit transactions, when we purchase items, sometimes items are not to our specifications, sometimes they're faulty, and we need to return them. Okay, so there's this thing called purchase returns allowances that I must show you how to do. And similarly, the same happens for sale. When one of our customers are not satisfied, they might return goods to us, whether it's faulty or not to their desired specifications. So they return for us. So we must account for that. So there's that complicating factor, as well as when we sell goods, we must account for the cost of goods sold. So we've got two complicating factors there. One, the returns, and two, to calculate the cost of goods sold, which I'll show you using this illustrative example, which is illustrated to you on page 84. Alright, let's start. The first entry, December the 1st, purchased good from General Electric for $1,870 GST inclusive. Okay, so the date, December the 1st, the particulars, we bought some inventories to put on our shelves. We have this complicating factor that we've got to calculate 1/11th of that for the GST component. So I'm just going to put that there, credits received. Okay, remember that when we purchase stuff, we record the rebate that we're going to get on the debit side. So 11th of that is $170. So the remainder is $1,700. So we purchase something for $700. The seller to us, they put on the GST component, so the total that we have to pay is $1,870. In this instance, it was a supplier that we haven't paid yet, so it is a liability that appears on the credit side for $1,870. There we have it. That's one of those items I did before, which is very similar to when we purchase any other good or service, like an expense, like you saw in the previous example. Okay, you've got the GST credits received, which ends up being a rebate that we're going to rebate back from the government. Alright, so that's the first entry. Now, on the third, what happened on the third, if you look at the next entry, we returned some goods. They weren't to our liking or specification. So essentially what we need to do is to mirror this entry up here, turn everything upside down, which really means what was on the credit side and that goes on the debit side and so on, because we're returning those goods if we don't have them anymore. It's another way of looking at it. So what we do, in the first instance, General Electric was the account there. The amount that we're returning is $220. Right. We also must reverse the amount of GST that we originally claimed for this rebate. The 11th of $220 is $20. I'm going to put that in this quickly there. So that is GST credits received. And inventories obviously goes down because if we initially bought that many inventories, the difference between those two items is obviously $200. And the amount of inventories, as you can see here, has gone down. Okay, remembering, just going aside to thinking about your debits and credits in relation to your ledgers. Okay, you had a debit entry to inventories there, a credit entry there, so we're actually left with $1,500 worth of inventories on the debit side. That's the net effect of these two transactions. Okay, let's keep moving. On December the 15th, we had a sale. And this is where we've actually got to do two entries to calculate the cost of goods component. So let's just first of all generate the sale, the revenue side of things, which is very similar to the service performed. So this was a cash transaction. So put that in. It was for $770. The GST component is 11th of that, which is $70. The amount of sales that we made is $700. Okay, the difference between the cash at bank and the GST component. So that was very similar to when we charged or performed some services. But we have sold $770 worth of stock, and we must adjust that level in our stock levels. And this is where I'm going to introduce a new entry. It's called cost of goods sold, also called COGS for short, and that'll be an abbreviation that I'll be using. Now, in your instructions it said that we sold goods for $770, but they only cost us $400. So the difference is obviously the amount that we use to cover our costs and to make a profit. So, but our cost of goods sold was $400, and if you think about it logically again, inventories need to go down to reflect the lower stock level. That's why it's a credit, and that hopefully makes sense to you. Right, if I keep going with the earlier example, when we returned inventories, we took them out, it reduced it on the credit side, and now we sold some, it again reduces the inventory account on the credit side. Okay, let's keep moving on. December the 22nd, we purchased some goods for cash, but they're GST free. Remember I told you earlier that some inventories or some items don't attract the GST. So that was for $550. It was for cash. There we are. So that's quite nice and easy. Be careful to read these instructions, to read these transactions, to see whether it's GST inclusive or GST free. You might have thought, being $550, oh yeah, it's divisible by 11, I must take a GST component. They do that deliberately in these type exercises to put you off a bit, but be careful when you read the transactions. Alright, December the 28th, we sold some more stuff, this time to M. Viviani. There we are. That person bought $1,615 worth of goods from us. It's got a GST component. Let's do my spelling a little bit better here. There we are. It's the 16th of that, which is $150. Amount of sales is $1,500. What we've got to do, we've got to work out what the cost of sales component of that transaction is. I'm just going to use abbreviation here called COGS. Okay, in the book they told us that's $14.56 for the cost of goods sold component. The inventories went down by the same amount. So what we've done there, we've recorded the sale and we've recorded the decrease in inventories along with our cost of goods sold. Now the last transaction is a little bit different. It's a sale return. In effect, it's really again the opposite to this, with just one minor variation which I'll note. Let me just go through it step by step. So December the 31st, what we've got first up, I'm going to reverse this part here. Now the transaction says that this $165 worth was returned by a customer, M. Viviani. Okay, but instead of saying sales, we have this other account called sales returns, which is just a slightly different account, and we must separate that one. Oops, made a mistake already here, because what I've forgotten is the GST component. There we are. Now M. Viviani returned $165 worth of stuff. I'm just going to put that in, okay, to make it more obvious. 11th of that is 15, which is the GST component. Now, you might think this is getting fairly complicated, but if you think about it, up here, M. Viviani, he created the debt to us. He owes us $1,650. We're going to have to pass on $150 worth of tax to the government, and we get sales of $1,500. But that's been reduced by this amount of sale return. So you can see that this GST collected decreases that, and every M. Viviani, 165 decreases there. So the net amount is actually how much he owes, and the net amount we actually have to pay to the government in terms of the GST component. So from that perspective, hopefully that makes sense. Also, what we must do is to recognise that some inventories have come back to us. In this instance, it was $130 worth, and the cost of goods sold has gone down because that amount has been reduced by the amount that we received back from our customer. So hopefully that's been a good illustration to you on how to record the general journal entries for a trading enterprise. Remember that we had the complicating factor of returns, both on the sales and purchases side, as well as having to account for the cost of goods sold and the reduction in inventories. Now take a bit of a pause. You'll be getting plenty of exercises from me to practice this, but for the purposes of the demonstration I've got one section to go, and that's to do with other transactions, which I'll get into now as well, but you'll listen to this a little bit later. Here I've got the illustrative example relating to other transactions. There are 5 special types of transactions which we must also remember and to account for in relation to GST, which I'm going to show you with these illustrative examples that start on page 87. The first one is to do purchase of an asset other than cash. Normally we buy inventories which we sell off to our customers in order to make a profit, but sometimes there's fixed assets, equipment, cars, buildings and so forth that don't get put through the same way, and I'm going to show you how to treat those. So in our first instance, on March the 9th, we had Nugan Industries, which is the business that we're accounting for. They purchased some equipment for $33,000 from equipment suppliers. So let's record the equipment first up. There it is there. We haven't calculated for the GST yet. I'm just going to get ready for that so we can see how it works. All right. And the liability account from equipment suppliers, let's put that one in just quickly. So in this instance what I've done is identified all the accounts. All right. I'm going to go a bit backward here and just build it up, but the reason why I'm doing this is to illustrate how you might use this process to find exactly what the GST component is so you don't get yourself confused. Now we paid, or we're going to pay, we had promised to pay equipment suppliers of $33,000, right, of which there is a GST component. If you divide 33,000 by 11, we're going to get a $3,000 rebate. Okay, that's the amount that is here for the GST credits received, which means that the balance is the amount of equipment that we actually purchased. Alright, so there you are. And in our equipment account we get 30,000 GST credits received, and equipment supplies, the amount that we owe there. It's very similar to what you've seen before in terms of when we purchased inventory. Okay, but we must keep that separate, and that's why it's been treated as such. Now on the opposite side, the business can sell assets other than inventories, and they must be treated differently. Okay, it's going to be very much the same, so I'm going to show you that then. What happened here, in this particular transaction, we sold furniture to furniture traders on credit. Let's put that in first. Furniture traders. The other two accounts here is that we sold some furniture. And when we sell items, as you know, we've got this thing called, or account should I say, GST collected, because whenever we sell some goods, whatever it may be, we've got to calculate the GST component. The amount that we sold was $1,100 worth. So that's how much Furniture Traders is going to owe to us, right? Because they promised to buy that or pay that in hopefully 30 days time. The furniture component is $1,000, and you can see that the GST collected, which hopefully you'll see quite easy, is 11th of 1100. Here, appears as a credit there to GST collected. So that's again very similar to what you already have been shown, but as I mentioned, if it's not to do with inventories, it must not be confused with it and therefore kept separate. That's why we do it this way. Now we're coming to March 11th. This is just totally different, and every owner who owns a business, they need at times to make cash withdrawals basically to live. Right? They try and minimise those as much as possible, because the more cash they take out, the less the business has to survive. So, but when they do it, there's this new account called drawings. So whenever an owner makes a withdrawal of cash from their business, it's called drawings, and it's known as equity account. In this instance was simply $200, and it was for cash. There we are. That's probably fairly simple. If it's very much the same if I'm going to pay for something, I debit my expense or credit the cash at bank. In this instance, it's drawings, it's owner's equity account, so debit, and cash at bank was reduced, it's a credit, $200. Two more to go. Now, what some businesses do, for example, if I'm operating a greengrocer or something, I'm not going to go to the supermarket and buy my greens. What I'm going to do is just take them off the shelf, but that needs to be accounted for. And this has got a complicating factor that most likely that we have purchased these items with GST component in it. So this becomes complicated. But let me show you how that works. In the first instance, again we've got this item called drawing. So whenever the owner takes something out of the business, either in terms of value or cash, it needs to be recorded. There was $132 worth of things that we took. It's inventories, because we took stuff off the shelf, and this is where the GST component comes into it. Right? Let's just think about this. When we bought it before, we would debit GST credits received. So that's the rebate from the government. Now in this instance, we've taken it out, therefore it appears on the credit side. So when we do our maths, 12 is obviously 11th of 132. The inventories that was reduced by is $120. Alright. So this is quite a complicated little transaction, but if you're struggling to understand this, have a look at the previous transaction where you saw when we purchased inventories. Let me just quickly go back to the example that I did before. Here we purchased inventories. We got the rebate, and that's the amount that we owed. Right? Now, if we're going to take some entries out, obviously we're going to credit entries, and also what we have to do is we have to credit GST credits received to reduce the rebate that we owe, that we're going to be owed by the government. So that's why, in this instance, we've got that happening. The last type of transaction that I'm going to cover, that's also in the book, on this time on page 91, sometimes we make a mistake, and these mistakes need to be rectified. So what we've got here, V. Nugent has mistakenly entered the sale of furniture to the sales account instead of the furniture account. So we must take it out of the sales account and put it in the furniture account. This is what happens. So it's currently sitting in the sales account as a credit, therefore we must debit that account and take it out of the furniture account. For $1,000. If you've not understood this particular transaction, what I will do, I will show you the original mistake looking at the ledger accounts, and then show you how then it would be put into here to put you fully in the picture. So let me go back in time a little bit. So what I'm showing you here is that they had a sale for furniture and they put it into the sales account. But as you learned earlier on, if it's a sale other than an inventory account, it must be treated separately. So this mistake here must be rectified. So they put the $1,000 into the sales account. In order to get it out of the sales account, we must debit the sales account. Okay, I'm just going to do that now. There. And we've got to put it against the furniture account. So now let's look at what's happened. The furniture account which was sold now has none in it, none whatsoever, and this amount here which was originally put to the sales account got cancelled out through this correcting entry. Hopefully that's been a bit more clearer